January 15th, 2026, 3:47 a.m. Eastern Standard Time. Tesla's Gigafactory Nevada received a notification that will fundamentally alter the trajectory of electric vehicle production worldwide. The message, transmitted through encrypted diplomatic channels, contained 7 words that instantly triggered the largest supply chain crisis in automotive history. Strategic lithium allocation suspended effective immediately pending review. The sender was not a mining company. It was not a logistics firm. It was the Ministry of Energy and Mineral Resources of the Kingdom of Saudi Arabia. Within 6 hours, Tesla's production lines in Nevada, Texas, and Germany began systematic shutdown procedures. By 2 p.m. Pacific Time, Elon Musk's emergency board meeting had concluded with a single directive: secure alternative lithium sources at any cost or face complete production halt within 72 days. But the Saudi decision wasn't targeting Tesla specifically. It was targeting the entire Western electric vehicle ecosystem that had become dependent on a resource most people never realized the kingdom controlled. For the past 18 months, Saudi Arabia's public investment fund had been quietly acquiring lithium assets across 3 continents through a network of shell companies and sovereign partnerships. The strategy was elegant in its simplicity. While Western governments focused on oil dependency, the kingdom was securing control over the metal that would power the post-oil economy. By December 2025, Saudi-controlled entities held operational influence over approximately 34% of global lithium processing capacity and 28% of high-grade lithium reserves. The official Saudi statement, released through their state news agency, cited technical compliance reviews and environmental impact assessments as the reason for the suspension. No timeline for resolution was provided. No specific violations were mentioned. The language was bureaucratic, measured, deliberately unrevealing. But the timing told a different story. The suspension was announced exactly 72 hours after the European Union's final vote on critical minerals independence legislation, and 96 hours after President Trump's announcement of expanded tariffs on Chinese battery components. The silence from major automotive manufacturers was deafening. Tesla's stock opened down 7.8%, but recovered to close only 2.1% lower. General Motors issued no comment. Ford's spokesperson referenced ongoing supply chain diversification efforts. BMW's press office was unreachable. The coordinated non-response suggested that the industry had received advance warning, or that the implications were too severe to acknowledge publicly. But the silence concealed a frantic scramble happening behind closed doors. Emergency procurement meetings were convened across Detroit, Stuttgart, and Ingolstadt. Corporate jets departed for Chile, Argentina, and Australia, carrying executives with blank checkbooks and authorization to secure lithium contracts regardless of price. The race had begun, but the finish line had already been moved. Financial cascade. The lithium spot market, already trading at historically elevated levels, experienced violent price swings that defied traditional commodity analysis. Within 48 hours, lithium carbonate futures jumped 23% before falling 11% in after-hours trading, as algorithmic systems struggled to process the supply disruption. But the real damage was occurring in the derivatives markets where automotive companies had hedged their lithium exposure. Tesla alone faced potential margin calls exceeding $2.8 billion on hedging contracts that assumed steady supply availability. Credit markets began repricing automotive debt almost immediately. Corporate bonds for battery-focused manufacturers widened by an average of 240 basis points, as investors recognized that lithium scarcity could render entire production facilities worthless. The ripple effects extended into equity markets, where battery technology stocks experienced the worst single-day decline since the COVID-19 market collapse. Panasonic, KATL, and LG Energy Solution collectively lost $47 billion in market capitalization before trading stabilized. Energy system implications. The Saudi move threatened to fracture the entire clean energy transition timeline that Western governments had enshrined in legislation and international agreements. Electric vehicle sales in North America and Europe had been growing at 43% annually, driven by mandates that effectively banned internal combustion engines by 2035. But those mandates assumed reliable access to battery materials at predictable prices. With lithium supply suddenly uncertain, the mathematical foundation of the energy transition began to collapse. Utility companies with massive battery storage projects faced immediate project delays. Grid-scale energy storage, essential for renewable energy integration, required lithium batteries that were now potentially unavailable. The result was a feedback loop where renewable energy capacity became stranded without storage, forcing utilities to maintain fossil fuel backup generation longer than planned. The clean energy timeline wasn't just delayed, it was architecturally compromised. Technological warfare. The Saudi lithium suspension exposed the fatal vulnerability in Western technology supply chains that strategists had warned about for years. China controlled rare earth processing. Russia dominated nuclear fuel. And now Saudi Arabia held leverage over the battery metals essential for technological independence. The pattern revealed a coordinated strategy to fragment Western technological autonomy through resource control rather than military confrontation. Silicon Valley's response was immediate but constrained. Apple, Google, and Microsoft accelerated research into alternative battery chemistries, but the development timeline for commercialization remained 7 to 12 years. Tesla's advanced materials team was authorized to pursue sodium-ion and solid-state alternatives regardless of cost, but scalable production was at least 3 years away. The technology sector found itself hostage to geological and geopolitical realities that innovation alone could not overcome. Geopolitical realignment. The lithium crisis forced Western governments to confront the strategic implications of resource dependence in ways that traditional energy security debates had not. The Department of Defense classified lithium as a critical defense material subject to emergency allocation powers. The European Commission activated Article 122 provisions that allow suspension of normal market mechanisms during supply emergencies. Both measures represented unprecedented peacetime interventions in commodity markets. But the crisis also accelerated geopolitical realignment toward resource-rich nations that had previously occupied peripheral roles in Western strategic planning. Australia's lithium reserves suddenly made Canberra a critical ally. Chile's Atacama Desert became a strategic asset requiring protection. Even Zimbabwe's lithium deposits, previously ignored due to political considerations, were now viewed as potential salvation for Western battery supply chains. The moment of irreversible change occurred not in Riyadh, but in Beijing. On January 18th, exactly 72 hours after the Saudi announcement, China's Ministry of Commerce issued Administrative Order 2026-03, temporary restrictions on lithium processing equipment, exports, pending technology transfer reviews. The order prohibited Chinese companies from shipping lithium refining technology, battery manufacturing equipment, and critical processing components to any nation that had not signed bilateral technology sharing agreements with the People's Republic. The Chinese move transformed the Saudi supply restriction from a crisis into an existential threat. Western countries didn't just need lithium, they needed Chinese technology to process lithium into battery-grade materials. The kingdom controlled the raw material, but China controlled the industrial capability to transform that material into usable products. Together, they held complete control over the battery supply chain that powered electric vehicles, grid storage, consumer electronics, and defense systems. The mathematical reality became undeniable. Western lithium processing capacity was insufficient to support domestic battery production, even with full access to raw materials. Building new processing facilities required Chinese equipment that was no longer available. Training technicians required Chinese expertise that was now restricted. The West faced a choice between technological dependence and economic regression. Emergency sessions convened simultaneously in Washington, Brussels, and London. The conclusions were identical. The free market approach to critical minerals had failed catastrophically. Strategic resources required strategic control, regardless of cost or complexity. The era of globalized supply chains for essential materials was ending. The era of economic nationalism was beginning. 6 weeks after the Saudi lithium suspension, Tesla's Gigafactory Nevada operated at 23% capacity. Ford's Lightning production line had been temporarily converted to hybrid vehicle assembly. BMW's electric vehicle launch was postponed indefinitely. The stock market had stabilized, but the automotive industry faced a fundamental recalculation of its electric future. The crisis revealed something more profound than supply chain vulnerability. It exposed the illusion of technological independence in an interconnected world where resources and capabilities were distributed according to geological accident rather than political preference. Western governments had spent decades building military superiority while ceding control over the materials that would determine economic superiority in the 21st century. The Saudi-Chinese coordination demonstrated a new form of strategic partnership that transcended traditional alliances. Resource controllers and technology holders could exercise collective leverage that no military force could counter. Economic warfare had evolved beyond sanctions and tariffs to encompass the fundamental inputs of industrial civilization. In corporate boardrooms across North America and Europe, executives began scenarios that had been unthinkable months earlier. Strategic reserve stockpiling, emergency supplier diversification, technology independence programs that would cost hundreds of billions and take decades to complete. The comfortable assumptions of globalized efficiency were being replaced by the harsh mathematics of strategic autonomy. The crisis was far from over. Alternative lithium sources existed, but developing them would require years and enormous capital investment. Battery chemistry alternatives showed promise, but commercial viability remained uncertain. The window of vulnerability would persist for years, during which Western economies remained dependent on the goodwill of countries whose strategic interests were increasingly divergent from their own. The automotive revolution that had promised to liberate the world from fossil fuel dependence had created new dependencies that were potentially more constraining than the ones it replaced. The question was no longer whether Western countries could achieve energy independence, but whether they could maintain technological relevance in a world where critical resources were weaponized by strategic competitors. The Saudi lithium suspension was not just a supply chain disruption, it was a demonstration of power in the new economy, where control over materials trumped control over markets. The message was clear, unambiguous, and irreversible. The age of Western technological dominance was ending, not through military defeat, but through the quiet acquisition of control over the elements that made technology possible.